It has already been established that everyone loves the idea of having a passive income. The kind where you do not do any work whatsoever, yet money keeps coming into your bank account. What if we tell you that you could have that life through dividends? With today's economy being what it is, with no relief in sight from inflation, the high cost of living and unemployment, having a retirement plan looks elusive, and that is capable of making one anxious about their future. Through dividends, you can have $3,000 paid to you every month for nothing. Stay right on to the end of this video to see how you can have a beautiful golden egg through dividends and learn how to get started on them, as I'll show you 3 strategies to getting this. Many people are like Simon, my friend, who constantly worries about his future. He knows it is very important to have a steady income as one grows older. The comfort it offers and having one's dignity intact are reasons enough to actively work towards the rainy days, and probably like you, Simon is only just learning about the huge relief called dividends. Dividend stocks are a popular choice for investors who want to earn a passive income. The term investors should not scare you to think about guys in fancy suits with a lot of money being the only ones who can do this. With a couple of $100s, anyone can be an investor buying and owning part of a company. What are the secret recipes needed to earn $3,000 through dividends investment? You'll learn this soon. Dividends are payments of profit made on a regular basis to investors who own part of a company's stock and who now become shareholders. With the immediate bills swallowing up what we earn, one can hardly think of a vague, far-off future. Thanks to dividends, you can solve today's problems without having troubling thoughts about the future. U.S. companies usually pay dividends quarterly, monthly, or semi-annually, depending on how it is structured. They can be paid in cash straight to your bank account or in the form of extra shares. Let us give a practical illustration about dividends. Now, Simon currently owns 40 shares in a company, and that company pays him $2 in annual cash dividends. Simon will receive $80 per year. And not stopping at this, Simon goes on to reinvest year after year, growing an interesting and rich portfolio. Now he makes some calculations and is amazed how a $5,000 investment growing at 6% annually for 20 years can make him $16,000. Simon says that's wonderful. Wouldn't you agree? Let us dive further. There are 2 ways Simon could decide to go about investing in a company's stocks. One is through mutual funds like exchange-traded funds, ETFs, that hold dividend funds which can also be called index funds. The second way is buying individual dividend stocks. As one new to investing in dividends, Simon might consider using ETFs over buying individual dividend stocks. Here's why. ETFs will grant him access to a variety of dividend stocks in just a single investment. ETFs do the work of finding and selecting the best companies for you to own. They're experienced and can make informed decisions about stocks for sale. After investing, your selected ETF fund will then pay you dividends monthly, quarterly, or yearly, which you can use or reinvest. Of course, reinvesting, also known as compounding of dividend income, is always recommended, especially if you're quite young and are far off from retiring, because the more stocks you have, the higher your payment. Now to you, here are 3 strategies you can follow to get a monthly income of $3,000. Stick around to see how to combine these strategies in the most simple way to achieve your retirement plan. The first is investing in covered call ETFs. This involves you putting money into ETFs that engage in writing call options on stocks they own. This strategy allows you to earn income from both the appreciation of the stock and the premiums received from selling the call options. To earn $1,000 monthly or $12,000 annually using this strategy, you'd need an investment of about $120,000, assuming the yield is 10%. The next is investing in high-yield REITs. Real estate investment trusts, REITs, are companies that own, operate, or finance income-generating real estate. They do this by leasing properties and collecting rent. This rent is then shared among shareholders as income and dividends. REITs offer investors the opportunity to possess high-priced real estate and enable them to earn dividend income to boost their capital eventually. To earn $1,000 monthly or $12,000 annually, you'd require an investment of about $80,000 if the yield is 15%. The third is investing in dividend aristocrats. This strategy involves investing in well-established companies within the S&P 500 index that have a consistent history of increasing their dividend payouts for at least 25 consecutive years, and have consistently increased their dividends for a certain number of consecutive years, indicating financial stability and reliability. To earn $1,000 monthly or $12,000 annually, one would need to invest $200,000, that's assuming the yield is 6%. Now here's how Simon can hit his $3,000 monthly target. He could either invest in one of the strategies or combine all three. With a savings of $350,000, Simon decides to allocate it across the three investment strategies to generate a total monthly income of $3,000. He invests $122,033.90 in covered call ETFs. With a yield of 11%, he gets $1,200 monthly and $14,400 annually. He puts $72,000 into high-yield REITs. With a yield of 20%, he gets $1,200 monthly and $14,400 yearly. For the dividend aristocrats, with a yield of 7%, he allocates $102,857.14 and gets $600 monthly and $7,200 yearly. His total monthly income from these investments: covered call, ETFs, $1,200, high-yield REITs, $1,200, dividend aristocrats, $600, gives a total of $3,000. This is how Simon is able to make $3,000 monthly by not actually working for it. If you are near retirement, there are things you can do to increase your gains quickly as well. The spread of your portfolio across companies done by ETFs ensures that you still have other sources of income to rely on in case of a fund cut or suspension of dividends by any one of your companies. So the whole business works like this. A company announces when its dividend will be paid, along with the amount and the ex-dividend date. Of course, investors would have bought the stock at least 2 days before the official date of a dividend payment, known as the date of record, so that they'd be eligible to receive that payment. If investors do not own stocks by that date, they will receive no dividend. But if they sell the stock after the ex-dividend date, they'll receive the dividend because they owned the shares as of the ex-dividend date. Now, if Simon were close to retirement, these are active steps he can take to boost his income. High-yielding stocks and securities like master limited partnerships and real estate investment trusts, REITs, do not generate much in terms of short-term growth, so he'd want to leave those for now. Since they do not do well in the short term, it is better for him to reinvest such stocks to increase his current portfolio yield. Also, there are some ETFs that provide dividend strategies for older ones, and if you are looking for current income, high dividend yield ETFs are a better choice. There are some risks associated with investing in dividends, and having the right knowledge can save you money. If Simon will be going the way of the individual investor, he will have more work to do finding suitable companies to invest in. Thorough research will be made on every stock to know that it is okay for purchase, because poor judgment will negatively affect his portfolio. This is not to say that investing without the help of ETFs won't guarantee success. On the contrary, an individual investor can be successful on their own too, and they can build a portfolio that has more yield than an ETF even. They can also save up on the annual ETF expense ratio fee. It takes time and dedication to build an individual portfolio of dividend stocks, but it's an undertaking that can be very rewarding. As said earlier, go for companies that are well established and periodically increase their payouts. Search out dividend aristocrats. This will be good for your portfolio, as dividend-paying companies will provide you with a measure of stability as you want to create a balanced and diversified portfolio. We mentioned there were risks associated with dividend stock investments. You'll have mostly nothing to worry about if you take these considerations seriously before venturing out to purchase stocks like Simon does. First, consider the company's dividend yield. Here's what you should look out for: if that of the company is much higher than that of other companies. Check out those whose dividend yield is 12.69%. That's the average for top dividend stocks. If the figures are much higher, it means the company could be in trouble and would eventually fail at some point, as it could mean that investors are selling the stock, which will drive down share prices and increase the dividend yield as a result. You'll also want to monitor economic trends and stay informed about the companies in your portfolio and periodically review and adjust your holdings accordingly. Next, see how much of the company's profit is going towards dividends. That's its payout ratio. You don't want to invest in one whose payout ratio is more than 80%. A company with a payout ratio of 100% is a risky one to invest in because it implies the company is not reinvesting back into its welfare, and it may likely run into debt paying out dividends. You can find out a company's payout ratio as well as its stock's dividend yield on financial or online broker websites. However, a company that makes dividend payments of 60% of its earnings is a good one to invest in because the company will use some of its earnings to maintain and grow the business, which will in turn provide a much higher return in the years to come. Diversification is also a risk management strategy that you can apply while investing. It involves spreading investments across different dividend stocks to reduce risk, rather than putting all your eggs in one basket. Now, by being aware of what a company's dividend yield is, you are equipped with the resources to compare dividend stocks of others, and you'll be able to determine where to get the most for your money. A $100 stock paying $0.10 quarterly and $0.40 per share annually has the same yield as a company with a $100 stock paying $1 quarterly and $4 annually. In this case, the yield is 4%. In the business of investing in dividends, yield and stock prices go together. When one goes up, it affects the other by reducing that of it, and vice versa. For a stock's dividend yield to go up, a company could increase its dividend. In that case, a $200 stock with an $8 dividend might see a 20% increase in its dividend, raising the annual payout to $8.80 per share. If the stock price doesn't change, the yield becomes 8.8%. However, there are some cases where the stock price could go up without any change to the dividend. And yes, dividend income can be taxed, but there's a way to avoid this, just like Simon does. If your shares are held in a taxable brokerage account, you will be taxed for it. On the other hand, holding shares in a tax-advantaged account like a traditional or Roth individual retirement account (IRA) frees you from paying tax on dividends. Investing in dividend-paying stocks, mutual funds, and ETFs is a sure way of taking care of your future. The cash flow generated by dividend payments over time can comfortably supplement your pension income. If you have one, or even if you don't, you'll be fine too. Yes, living off dividends is possible if you go about it the right way. And while this journey is incredibly rewarding, it requires patience, dedication, and a well-thought-out strategy. Set realistic goals for yourself, build a robust dividend portfolio, and understand the power of reinvesting your dividends, and you'll achieve goals you didn't think possible.